Hi, welcome back to Investment Mindset channel. Today in this video, I will be sharing with everyone a stock I plan to buy into, that is Datasonic Group Berhad, barring stock ticker DSonic 5216, last close at 39 cents per share on Friday 1st November, as I believe strongly that this company is currently undervalued. Year to date, many sectors trading on Bursa Exchange are down, except KLCI Index, which tracks the 30 largest companies listed on the main board of Bursa Malaysia, which recorded a gain of about 10% year to date. Year to date, we get to see that Bursa technology sector stock has been down by around 8.05% as shown by the Bursa Malaysia Technology Index chart over here, whereas DSonic stock has been down by around 6.16% year to date, which is still slightly better than the overall technology stock listed on Bursa. First, let me shed some light on the background of Datasonic. Datasonic principally involved in the provision of ICT solutions, including the smart card personalization such as secure ID or chip-based credit or debit or bank cards, customization of software and hardware solutions, project management, consultancy, R&D, and technical consultancy services. Datasonic has been the exclusive provider of MyCard since year 2012 and a major provider of EuroPay, MasterCard, and Visa chip-based credit and debit cards in Malaysia since year 2003. The company is also one of the few regional players capable of producing 100% polycarbonate data pages in-house. In May this year, Datasonic has secured their first overseas e-passport project in a West African country, highlighting its robust technical capabilities, especially its in-house produced polycarbonate documents. On June 4th this year, the group, via DTSB, secured 5 contract extensions from the Home Ministry worth a total of RM 181.66 million. This includes the supply of MyCard, MyTentera, and MyPoca raw cards and consumables to the National Registration Department or JPN, and comprehensive maintenance services for card personalization centers at the JPN. Datasonic also received contract extension for the supply of Malaysian passport chips worth an additional RM 59.77 million, Malaysian passport document worth RM 29.81 million, and polycarbonate biodata pages worth RM 52.7 million to the Immigration Department. Additionally, Datasonic secured a RM 30 million contract in July this year to supply smart cards to Perum Percetakan Negara Republik Indonesia, or in short PNRI, which is a state-owned printing entity under Indonesia's Ministry of State-Owned Enterprises. On July 29 this year, Datasonic also secured another 2-year contract from government, which was worth over RM 21 million, to rent out 818 vending machines for the implementation of the People's Income Initiative, or in short IPR program. The management expects the contract to boost its earnings and net assets for the financial year ending March 31st, 2025 and beyond, without affecting its shareholder capital or major shareholder stake. On top of all this, according to the Executive Director Dato' Abdul Hamid Mohamad Hanifah, the group is actively pursuing expansion strategy by exploring synergistic collaborations in both locally and key regions, including in East Africa and the Middle East, while capitalizing on its technical expertise and proven track record. Now let us take a look at its historical financial performance. The company has been consistently profitable in the past 5 financial years, and its net profit decreased from RM 60.3 million in financial year 2020 to RM 7.3 million in financial year 2021, but rebounded to a high of RM 92.3 million in financial year 2024. The increase in net profit from financial year 2021 was driven by higher revenue and improved margin. When we take a look at its most recent 3 quarters earnings, the company's financial performance has been not so consistent, though total net profit during the year was still higher year on year. Still, there are a few financial ratios of Datasonic which I think stands out and attract my attention until this stock. The first one is its ROCE, or Return on Capital Employed. Return on Capital Employed, or in short form ROCE, measures how efficiently a company uses its capital to generate profit. It considers both debts and equity capital. Let's say today if company A go to a bank to get a loan to start its business with an interest rate of 10% per annum, which means their cost of capital is 10%. And let's say that this company A reinvest the loan and get an 8% return. In this case, this company A is losing money. They are destroying wealth because their cost of capital is 10% while their return is only 8%. While you might think that this scenario is bizarre and it never would have happened in the real world, let me tell you, many companies are doing exactly this right now. Many a time, their cost of capital is very much higher than their return on capital. So if you have a company in this category, know that they are destroying wealth, and if you have this stock in your investment portfolio, they are destroying your value in your investment portfolio. You should not hold or invest in a company which has persistently higher cost of capital over its returns of capital. Now, let's say we find a better company B. This company B go to bank and they get a loan from the bank at an interest rate of 10%, which is the same exact cost of capital as company A. But this company B has a more efficient business model. They have a better product with more pricing power. Instead of getting a return of 10%, they could get up to a return of 20%. Even though the cost of capital is the same, but this company B is generating a higher rate of return at 20%. Thus, it is generating wealth for the investors. This company will create wealth over time. So in summary, only invest in company which could produce a higher rate of return over its cost of capital. Never invest in company which produces lower rate of return on its cost of capital employed, because they will only destroy wealth instead of creating it. This is a powerful financial ratio you must not overlook when choosing to invest into a publicly traded company. If you want your investment to grow, you would need to invest in company which produces higher rate of return over its cost of capital employed. And this brings us to Datasonic ROCE. As you could see from here, as of June 2024, the ROCE for Datasonic stands at 36% with an average of 18% per annum, while the industry-wide ROCE is only at 4.4% per annum. An ROCE of 36% versus its weighted average cost of capital of 7.84% per annum, that is a tremendously good rate of returns, I would say. Don't you agree? And the second important financial ratio which I saw was its dividend yield. Datasonic is a dividend-paying company. One of the best ways to measure a company's performance is also via its dividend-paying policy. We could see that Datasonic has been consistently paying dividends since its inception way back in year 2013, and its dividend per share for Datasonic has since increased by 200% over the past 5 years and 370% over the recent past 3 years. As of its most recent price, Datasonic stock is trading, that is around 39 cents. It has a dividend yield of up to around 8%, which is more than double the return we get if we were to put our money inside fixed deposit, which only get us around 2.5 to 4% return per annum. Based on such a high dividend yield of 8%, do know that its dividend payout ratio is standing at around 84%, which means out of every 1 ringgit of net profit earned by Datasonic, the company is paying back 84 cents to its shareholders in the form of dividend. On top of that, I also noticed that Datasonic management has been buying back its shares progressively since year 2020 till today. And this progressive share buyback has resulted in its common share outstanding to be reduced from 2.865 billion to 2.796 billion as of March 2024. And this is beneficial for its shareholder, as when the number of outstanding shares decreases, this can lead to an increase in the earnings per share even if the company's net income remains the same. Additionally, by repurchasing shares, a company can increase its ownership stake, making it more difficult for hostile takeover. So with Datasonic management doing share buyback and paying dividend consistently year over year, we could see that Datasonic spotted a shareholder yield of 9.57% per annum, which is almost 10%. Shareholder yield is a metric that measures the total return a company provides to its shareholder. It encompasses both dividends and share repurchases. A higher shareholder yield indicates that a company is returning more value to its shareholder. It is a useful metric for comparing the overall return potential of different stocks. In other words, today, if you buy into Datasonic stock, you would receive a return of almost 10% per annum on your investment, even if the stock price declined in prices. Of course, this doesn't mean we should just buy into a stock by basing on its high shareholder yield or high ROCE return. In fact, we should always try to find out its intrinsic value. For Datasonic stock, since it is producing positive free cash flow and also a dividend-paying stock, there are at least two reliable ways to compute its intrinsic value. The first one is via discount cash flow computation. Based on the DCF valuation model created by Alpha Spread, Datasonic stock recorded an intrinsic value of 59 cents on a base case scenario. And the second valuation model, which is via dividend discount model based on its average dividend per share of 0.03 ringgit, risk-free rate of 7.9%, which is also the cost of capital for Datasonic, and market risk premium of 4.06%, beta of 0.9, I get an intrinsic value of 43.7 cents for Datasonic stock. So at the current price, Datasonic stock last traded on 1st November Friday at 39 cents. Both models indicate that Datasonic is undervalued now and is a buy based on its intrinsic value. But as promised, I would also take a look at its technical chart for best buy entry point. If you are to look at its weekly chart at a glance, we could get to see the upsloping dotted line which has held as a strong support historically. And see how currently Datasonic stock price has since hit this strong support line at around 37.5 cents. And now if you were to zoom in closer, you get to see a wick at the bottom, which indicate buying interest stepping in to buy up Datasonic stock when it hit a low of 37.5 cents. This is the daily chart. See how buying interest repeatedly bought into Datasonic stock each time it hit a low of 37.5 cents on both occasions, that is on 29 October Tuesday and then also on the 1st November Friday. This reinforced to me that 37.5 cents serve as a strong support level. So any entry price at 39 cents and below would be a good buy. And since Datasonic stock is still under a downtrend, I would not be overly greedy on its target price. As a swing trade, I would be happy to lock in my profit at around 43 cents, which coincides with its intrinsic value based on its discounted dividend model. This would represent a potential upside profit of about 10.25%. But if I plan to buy it for investment purpose, I would only sell it when it reached my intrinsic value of around 59 cents is reached, which would also form a double top. This is not impossible, but would take time. We are talking about matters of months to maybe 1 to 2 years. And based on the entry price of 39 cents to the target price of 59 cents, this would represent a potential profit of 51%. Wow! But what if after I bought into Datasonic stock at around 39 cents and below, and it continued on its decline and even broke its historical strong support level of 37.5 cents? With current choppy trading environment, especially on the backdrop of a looming US presidential election that is to be held on the 5th November, Tuesday, and this scenario is possible. But I am prepared too. Should this scenario occur, I would just hold on to my trade in Datasonic. No stop loss. Just take it as I'm putting my money into a fixed deposit and enjoy a high dividend yield of around 8%. I highly believe, based on this company's good fundamental and strong balance sheets, when the market sentiments turn back into a bullish one, this stock shall start to perform. Please be reminded, I will only hold on to stock which is highly profitable, generating consistent free cash flow and with strong balance sheet. That's all for now, and I hope you enjoyed this episode. And if you like this kind of content, do smash onto the like button below to let me know so that I would continue to churn out similar content in the near future. Feel free to also comment your thoughts on Datasonic stock. Do you think this stock is undervalued at current price it is trading, or otherwise, and why? So long, and I shall see you again in my next video. Ciao!